Coming Saturday on 28th June, we have 3 power-packed webinars only for you. On 10 a.m., how to turn your dreams into financial milestones. On 11 a.m., energy transition for Viksit Bharat, sustainable and net zero India. On 11 a.m., we also have a Kodishwari special women-only webinar on how to plan for your daughter beyond just marriage. All the 3 links are in description. Go register for your webinar today.
The market never fails to surprise us. We'll be very surprised only if the unexpected doesn't happen. So, if you look at what happened so far in this financial year, we've had numerous events happening. We had the tariff tantrums by the US, followed by the Indo-Pakistan face-off, and then we are now seeing Israel and Iran going to war. You're seeing America also getting into this situation. We don't know which are the other countries that are waiting to get into this conflict. And we don't know how many more events we would have in this financial year. From the looks of it, it's going to be a very interesting year and a very active year. So, in times like these, the investor in us is always wondering whether we are doing the right thing, whether we should now do nothing, what we should be doing when things become tougher, whether we should invest money now or after the markets go up. Should we bet on this uncertainty going away, or should we only bet on certainty whenever we see it? All these dilemmas are before us, within us, around us. But as an investor, we need to beat these dilemmas and reach conclusions, make decisions, and generate actions which will fulfill our investment objectives. That is our primary duty. There is no escaping that. But still, while we know there is no escaping that, the way in which we fulfill these duties is going to make a huge difference to the investment outcome that we are going to create for ourselves. Now, this is true whether you are an investor or an advisor or an investment manager. Whatever be the role you fulfill, your approach has to be the same. It can't be any different. It is important for us to constantly revisit common questions that come in the way of our executing this approach. And that is what we are going to do today with Ashwin, my colleagues. Ashwin, over to you. What are the questions that you feel are coming back again and again to us? And what are the questions that you feel we need to cross if we have to go ahead and fulfill our investment duties?
Absolutely, Shyam. So we are faced with uncertain times, a war-like situation which is only exacerbating. And in this situation of a global uncertainty, and in this situation where India has done rate cuts, the Federal Reserve is now saying that they are not in a position to do more rate cuts. How do we approach markets in this kind of an uncertain situation where war situation can even become worse? We are not seeing the existing wars ending, but new ones starting.
See, clearly, there was a phase when we felt that inflation was going to move south, go down, and the benefits of falling inflation would reflect in monetary policy. Now, that process has more or less played out. If you look at India, the RBI has advanced its rate cut and clearly told that it is no more in a position to promise an accommodative stance. That is what it has said. The Fed, unlike the RBI, is not having a harmonious relationship with the government. As a result, the messaging from the Fed is not coming out as clearly as the RBI is saying. The clarity is not there, but the messaging is pretty much the same. We don't see the Fed being in a position to cut rates in the current scenario of inflation. I'll be very surprised if that happens. Which means that the macro economic situation in the US is suddenly looking more vulnerable
Absolutely.
than it looked 1 year ago. And you're seeing those auctions where nobody bought.
Nobody bought.
So these are all telltale signs for us. Now, should we become very big pessimists based on these actions? Probably not, but we should always keep a close watch and an eye on these things. And we should not use these situations to become cynical. At the same time, we should restrain ourselves from being gung-ho. So it's a more pragmatic position that we need to take on this. And global factors will weigh on our markets. We have much better local clarity on where the economy is going. But we also have clarity in the valuation of the asset class, that is equity, within India. So we know it's not cheap at a secular level. Only pockets of value are available. So I think it's a situation where we need to be very restrained in our investing, yet we should be able to deploy capital responsibly. It's not gone to a phase where you cannot deploy capital. I would put it that way. That is as far as India is concerned. As far as US market is concerned, we must exercise restraint. And we'll have to wait to see how the central banker and the government start working together. I think it's very important for them to work together. The confrontationist approach which we are seeing today is not sustainable, and it has consequences not only for that country but for the whole world. So I think that has to change. I don't know how they are going to change, but see, knowing US, these things happen very fast. We are not the best predictors of when this will happen. Suddenly something may happen and then they'll come together and then they'll talk. They'll agree on what is doable and they'll quickly move to doing things. So the way in which they will action will lead the world. So we'll have to keep watch on that, and we should not think there can be no surprises. We should be ready for surprises.
For an investor in this time frame, would hybrid funds or the multi-asset kind of options, would that be a good point in this uncertain times?
So I have been noticing from the 2008-9 GFC, I have been a very active observer, analyst and strategist in mutual funds. I played that role only from that time. It's nearly 16 years. In these 16 years, what I have learned is that only one approach is fail-safe for a investor in mutual funds. That approach is a multi-asset approach. No other approach, either a pure equity or pure debt or hybrid, which is nothing but a swing between debt and equity, or a dynamic asset allocation, which allows the hybrid to invert. None of these things have that holistic structure and flexibility
that a
multi-asset approach can give. So why is it not as popular in India? Because I think that the financial product industry, by saying that I mean the asset management business, is a fee yield driven business. The moment you change your approach to multi-asset, my sense is your fee yield drops by 40%. Okay. Now, I have consciously followed this yield approach in my activity for many, many years. And I am ready for that. Because I feel that by lowering the fee yield in a distribution, you are going to secure the financial interest of the investor. You are to making everything very resilient and robust. And you actually growing his assets faster. You know, that is the most interesting thing that I have seen. For example, I will give you, in the last, let's say 12 to 18 months, whether it's through mutual funds, where we have very significant activity, or through PMS, which is a sphere, which is a product, in both places we did one thing. We bought precious metals, gold and silver. Now you just imagine, you are a mutual fund distributor. You are buying 100 crore worth of gold and silver for your clients. In this 100 crore, I'm telling you what happened.
Correct.
In this 100 crore, we make a gain of 50-60 crores
Yes.
capital gain.
Because that's the movement.
Yes. We have bought this 100 crores so that he doesn't lose money.
Yes.
Please understand. It's a defensive bet.
Correct.
And we have bought it as a hedge against the rupee also weakening potentially.
Correct.
Many things are there in that bet. So you bought it as a hedge. You bought it for 100 crores. And on the 100 crore, you make 60 crore profit for the client in 1 year. Even with that, your income from that product will barely be 12 to 13 lakhs. Right?
Correct.
But I am of the view that if you are a mutual fund intermediary, you have to keep looking for things like this which don't give you any revenue,
Add for the value.
but add enormous value for the client. So when you do that,
Yes.
later when you want the client to shift to equity or even go to debt,
Correct.
whatever is in his interest at that point in time, he will go along with you.
Yes.
So multi-asset basically gives you a very harmonious client-investor relationship.
Correct.
It reduces the cost for the client, whether it's in distribution or wherever, even in a PMS.
Correct.
And it gives a resilience to economic context.
Correct.
And it also gives you flexibility. I'll give you an example. So, in 2022, we had the opportunity to switch out
Yes.
of gold
Yes.
when it was at the peak after COVID, 21-22, and switch to equity.
Yes.
So, we were telling people, this can be done.
This can be done.
Those who listened made significantly higher returns than those who did not listen. But we persisted even with those who did not listen. This time, we reminded them in 2022, you are not willing to, 21-22, you are not willing to sell.
Yes.
Today, I am telling you again, you have to move, you have to,
Move back.
you have to rotate your asset class.
Correct.
Now they agree.
Yeah.
So it takes 5 years
Yes.
to make an investor understand what he misses out, how he should see it differently. But for us, it's the same thing.
Yes.
This approach I am doing from 2009. In 2009 also, we were betting on gold. In 2013,
Yes.
we got a phenomenal
Opportunity.
to exit.
Yes.
So whenever we feel the macroeconomy is not looking favorable, whenever we feel that gold as an asset class is a very good hedge against macroeconomic instability globally, then we will go into gold.
Yes.
Whenever we see the rate cycle going down, we'll go into debt. We'll increase the weightage. At all times, everything will be there. At other times, we reduce the weightage. When we feel asset prices are very cheap, then we'll go into equity. When we feel asset prices become further cheap, then we'll go into the more return yielding parts of equity like mid cap and small cap. So, it's like a giant wheel, you know.
And seamlessly it kind of.
Yeah, it's seamlessly. The transitions you can make very seamlessly. And in a simple mutual fund space, you are able to bring in a sophistication which is tremendous. The reason why we also have a PMS and we are not doing it only in mutual fund is the advantage of doing direct stocks on the equity.
Yes.
Okay, reduces the TER for the client.
As a client.
Right? So, we are able to reduce intermediation costs significantly and our fee is like an advisory fee. And the yield actually goes up for the client. I knew this in 2021-22, which is why I told our colleagues, shut down the RIA.
Okay.
We can save that 150 basis points for the client by doing it through mutual funds. We need not pay the RIA fees itself. If the client still wants to do it in mutual funds, let's just do it under distribution. So basically, we reduce the cost in distribution. So RIA, we are getting a 1.5% plus GST. In distribution, our yield is only 0.6 today at overall portfolio level. That's all. So we have reduced the cost to the client by 2/3. That's here. In the PMS, we have enormous flexibility in buying the equity. So the efficiency which you bring is only the fee. So actually, the client actually doesn't incur a cost. For all this, it is possible because of the resilience and the robustness of the multi-asset investment approach and our way we have practiced it for 15-16 years.
Absolutely.
So in my opinion, it is superior to hybrid or dynamic asset allocation.
Correct.
Because both hybrid investing and dynamic asset allocation investing is formulaic and it does not have flexibility.
Correct.
So you are not practicing investing in both like an art.
Correct.
You are just going by a formula.
Percentages, then
Whatever you increase, if the Nifty goes to this valuation, you increase equity. If it goes, now all this can possibly give you Nifty returns plus 1 or 2%. That's the best case. If you have to generate more than that as a delta in those products which promise hybrid or dynamic asset allocation, what is the industry doing? It is going and buying higher risk equity.
Yes.
Okay. I am not for such generation of returns. Philosophically, I feel that don't tell the investor that you are doing a conservative thing
and then go
and do something else which is completely to the contrary without the investor knowing that I am not for all this. I like to have a very clean mosaic of assets where the investor is very, very clear where we are taking risk, where we are not taking risk. It should not be hidden as a line item inside a portfolio.
Yes.
I don't agree with that. That is why I don't generally prescribe dynamic asset allocation products or hybrid, because in both they are buying risky parts like small cap and mid cap only to generate beta, to generate benchmark outperformance. As a philosophy, I feel that the investor doesn't know this, and if the investor knows the kind of risk that is taken on that side, he will probably not be comfortable owning the product. So my investor is relatively in a more comfortable position, whether he is in a MF stream or in the PMS stream, because I have understanding of what is the risk that I can take in this stream, and I am not taking any license. I may buy a small cap, but I will buy a pure small cap product and weight it and transparently tell my client this 5% or 10%
of your portfolio
is the risk I am taking. I should be able to pinpoint and tell him that this is the risk. And the rest of the thing must make him sleep well. I am not of the view that today either dynamic asset allocation or
are doing
that. That is my grievance with them. But, as long as the market is willing to accept these things, it's fine. My aesthetic is that this should be done very differently.